Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hi, everybody. Welcome to Vantage Point with True North Wealth Partners. Eric Soucy here. Today is Tuesday. It is December 19th and 2023. Episode number 41. So we appreciate you joining in. Always be sure to hit that subscribe red button there so you can follow us as these get produced. You'll get that notification automatically. So in today's episode, we're going to cover a lot. Unfortunately, Andy is out, could not make it. And then we're going to have a special guest, though. It's going to be Eric Biddle. So Eric Biddle heads up our True North Insurance Partners division. And we're going to talk about fixed index annuities. So it's been hot of this past year and heading into next year as well, just because of interest rates have been elevated. So we'll bring him in and we'll talk about that later on in the show. So a lot to cover. You know me, I'll make this as educational / entertaining as possible as well. So you all can walk away with something, you've learned something about what's going on and truly in the markets here. So I'd like to just start off with a little graphic here. This is from Bill Rich from Hedgeye. Obviously, one of our research partners that we lean on. But with this, as I'll hold this up, you'll see basically, I work in manufacturing. We make widgets, gentleman says at the holiday party. Wall Streeter goes, I work on Wall Street. We make believe. So that sums it up nicely, quite frankly. What has occurred all year long? So the rolling recession is still a rolling recession. So let's get into really what has happened. So up until November 1st, we as an entity here were outperforming the appropriate benchmarks, which was the Dow Jones portfolio moderate index options there, the DJPI models. So again, we were doing fine this year, but with the past 7 weeks, from basically November 1st on till now, 7 weeks, the market's been straight up on fuego.
The show goes on!
So it's been crazy. No one really saw this happening per se. But so with that, now we are lagging the appropriate benchmarks a little bit. So with that said, 2022, we outperformed with less risk. 2023, it looks like we may underperform slightly, but with a lot less risk as well. And I talked about less risk. It's just basically that standard deviation on the performance reports. We're basically taking about 40%, a little over 40% less risk than the appropriate benchmark. So that's the good news. Your portfolios are still built with a lot less risk than the appropriate benchmark. And heading into next year, that's still a good place to be because of what's coming. And I'll share with you what's coming from what we can gather. A little market recap. So yeah, year-to-date highs. So the Dow, again, that's all-time highs, over 38,000. S&P is a little more than 1% from hitting its January 2022 highs, over 4,800 on the S&P. So real close to hitting that as well. Year-to-date, the sectors, there's 4 sectors out of the 11 sectors that make up the S&P 500 index. So the consumer staples are down over 1.36%. Energy is down 1.69%. Healthcare just down 0.02%. So it's called flat. And then the utilities are down 7.01%. This is coming from First Trust, one of our research partners, week ending here December 18th. So again, 30-year mortgage rates have come off over 8%. Now it's down to 7.27%, just to give you a little recap there. So just a little stats to make you aware of things. The small caps that were lagging has had a nice little rally here over the past few weeks. And technically, things are, yes, broadening out somewhat. You still have the Magnificent Seven, and they're still, I call it 7 to 10 big large cap stocks are holding up everything. But with that said, this is coming from one of my research partners too, James Grant. So with him, the grants, almost daily grants, his little informational sheet. This comes on Friday, December 15th. Call it the Magnificent 95. So this is coming from Charles Schwab, Chief Investment Strategist, Lizanne Saunders. So basically, she calls it the Magnificent 95. So this is back on Friday, December 2023, December 15th, 2023. Fully 19% of the S&P 500 components logged a fresh 52-week high on Thursday. That's what she said. And making it the highest such share of the market share there since May of 2021. So all of that's saying is the components now is up to 19% of the S&P 500 components are at 52-week highs. So it's broadening out from 8, 12, 15, now it's 19%. So there's more and more companies that are participating, and that's the highest participation rate, fully 19%, since May of 2021. Again, that's from Lizanne Saunders from Charles Schwab. So that's some good news there. So yeah, we're having that, remember, Christmas rally. They're pulling it in early, so they're pulling forward 2024 returns. That's all that's been going on. And with that said, I'm going to get just a little technical briefly, just because its history was made, okay? So I'm going to hold this up as well. And this is from the Tier 1 Alpha, part of the Hedge Eye team that we use. This is the market situation report I get daily from them. And with that said, basically on Friday, remember folks, the third Friday of every month is notional options expiration. So expiration occurred this past Friday, and basically record all time $3.24 trillion of SPX and SPY total notional option interest expired on this past Friday on 12/15. Again, 3.24 trillion. So what does that mean? As you can see on this chart that Nathan is still sharing with you, typically it's been around 1 trillion or so. So it's more than double, not 2, 3. So 3.24 trillion. So I say all this as basically, this is getting a little technical here now, it's just not all, the vast majority of the fund managers were underperforming their peer benchmarks. So what happens, again, having worked at T. Rowe Price and the trading pits, and information from the Tier 1 Alpha and what they're saying as well, the fund managers and even our guy from Hedge Eye, Keith McCullough, these fund managers, a lot of firings go on in Fridays in the month of November and December. So if they don't close the gap of the benchmark of how they're lagging, try to close it or outperform, you get fired on a lot of these Fridays. So that's point number one. Number two, it's called painting the tape. So painting the tape, and this is market manipulation. This is the dirty little secret within the index and how the markets really work. They wanted to hit 4,700 on the SPX, on the S&P 500 number on Friday for expiration, and it did. It held over 4,700. So all the fund managers who had the calls and puts that expired per se, they all got paid. So their positions paid out. And then third, dirty little secret is that helps them get their bonuses. So I remember the payout bonuses at T. Rowe Price back in the .com year 2000. So I remember vividly they were popping champagne corks on the trading floor in December. And here for my Christmas present to them, I gave them Buckeyes. A lot of these guys are Ivy League and girls. So they went to Yale, Harvard, all the, Princeton, all the Ivy League schools. And here I am from Ohio State. And they didn't know what a Buckeye was per se. So I passed around Buckeye candies for them. So I vividly remember, but that's sort of the three little things that go on when it comes to the Santa Claus year-end front running and not front running, but just pulling in forward returns from 2024. So I want to share with you what has been going on and what will continue to go on, basically because on the positive gamma, again, 0 days, the expiration has really changed the game. It's really showed up in 2023 and forever, basically. And right now, the positive gamma, this is getting a little technical, but the markets are set up into a positive gamma situation. So all that means is when the exposure it has set and it did roll off, and that occurred on the expiration here on this past Friday. But what it means, I'm going to read a little bit here. What it means to the market is going to lose its key stability force. This means that the market will become more sensitive to exogenous shocks, which were previously being absorbed by these positive dealer flows. So again, as of today on the call I was on, if the S&P happens to go down as of today on Tuesday, the 19th, if the S&P were to lose and go down negative 1.5%, that's called the flip line. So if the S&P were to go down 1.5% intraday or any time, that's the flip line when you go from positive gamma to negative gamma. And then that's when the party starts, folks. That's when the market's systematic trades go in, 3% losses go to 5%, 5% it goes to 8 and 10, et cetera. It's a snowball effect. All computerized algorithmic trading that kicks in. So that's what we haven't had for a few months. And that's more than likely what's coming in the first quarter, which is a couple weeks away. So just peeling back the layers, that was a little technical, but you know me, I'm a geek. I track it all. Shared it with the guys here in the office, Eric, Andy, Jim, Russ, all the crew. But so that was getting in the weeds, but I wanted you to understand how that works and why, $3.24 trillion an options expiration rolled off and on this past Friday. Okay, so that's what has happened. Let me share with you some economic conditions and where are we as of today. So number one, this is coming from FactSet. Okay, so FactSet, I get a lot of their information, and this is as of their December 18th from FactSet. So with that said, and again, I'll hold this up, and Nathan, our producer, will focus in on this for you here. But as you can see, the earnings growth and revenue growth for 2023, yes, it's come off the highs, as you can see, the blue lines and the green lines, but the earnings for calendar year 2023 is 0.6 positive. So that's good. So instead of being negative, it's going to squeak out a positive 0.6. Okay, the sales growth, again, that's going to be a positive 2.3%. This is coming from them as of December 18th. So things have slowed. We all have been talking about that. Things are slowed, but at least it's positive, thus far. So that's FactSet. Okay, so where are we next? This is from Sentiment Trader, another research subscription that I subscribe to. This is Smart Money, Dumb Money. Again, you can punch into this and see this little sheet. So with Sentiment Trader, this is coming from last night, 12/18. Printed this out. Smart Money, Dumb Money. Focus on the bottom clip, okay? And you see the red line. That's the dumb money confidence indicator. It's at 88%. That's near all-time high since when? Since July. Remember, July 31st was the high for the year up until right now. So, and then you can see what happened after, remember, after July 31st, you had August, September, October, 3 months of a decline. Okay, that was a correction that we had, 10%. So with that, not saying, past performance is never a guarantee of future results, but however, things are setting up similarly to, smart money, dumb money. The institutional money, 41% is confidence. That's the blue line. So it's just a factor, things that I look at. So that's number one, that's another point. Another item here, you heard me talk about the Fear Greed Index as well. So the Fear Greed Index, again, it's produced by CNN. .com, and this is as of December 19th, 11:53. I just printed it off. So we're at 79. So it's made up of 7 indicators. Right now it's pegged at 79. Obviously, you want to buy in when it's below 25. You want to sell or be careful when you get extreme greed. So that's where we're at right now. We're at 79. Basically, a week ago, we're at 67. A month ago, we're at 58. And a year ago, we're at 39, just to give you a relevancy. So a year ago, 39 on this day, and today we're at 79. Just shows you how things move around. Fear Greed Index. So it gets another thing that we look at as well. Some other things that are interesting. Again, this is coming from Hedgeye. So people are stretched. We've been talking about that, especially in the lower income brackets. So I always like to say, and Nathan will put this up. This is again coming from Bill Rich from Hedgeye, great cartoonist. So it reads here, "What's in your wallet?" You hear that commercial, Capital One, I believe. And then husband and wife are sitting down. "Nothing. That's why I'm paying over 25% interest rates on 5 different credit cards." So people are maxed out, and they are paying the average rates almost 23% right now. Some I've seen a card at 29.99, et cetera. So just a little light humor there. But unfortunately, with this is Discover Card. Again, this is coming out from Hedgeye, the early look email I got on 12/15 of 2023. So with that, again, I get so much information that comes out daily, but just so I wanted you to see visually, where are we? So, the quote, the worst of credit is behind us, ? No, it's not, most likely. So it's all about rate of change. So you see the red arrow, the rate of change, it was 1.5% delinquency rate. Okay, this is 30 days plus delinquency from the Discover card. And Capital One's the other card that they follow and have a lot of exposure. That's really the rate of change have increased dramatically. I'm just showing you right now the Discover card. So coming from off the floor of 1.5 to 3.76, that's a huge rate of change over the past couple of years. And then you can see the bubbles highlighted in red there. Basically, January 2011 was another, high of 3.76. And you see the Great Recession there, July of 2007, and then January 2006 as well. So, we anticipate this to go right past that number, 3.76, and to go higher as far as a delinquency rate. So again, that comes from Hedgeye, just sharing you information about that. Moving on, and then we'll people say, okay, Eric, Andy and Eric and I were all talking about 2024 repositioning, looking at the portfolios and things of that nature. I'm going to fan it out this way first. So there's a lot of information right here. So, so we have LPL, Innovator, NDR, Ned Davis Research, T. Rowe Price, Goldman Sachs, amongst many others. But just wanted you to see things that we follow and read. But I'm just going to just point out a few things. So the outlook here, this has come from LPL. So I'm just giving you a glimpse of 2024 outlooks from different folks, different institutions. So basically, folks, it's a flip of a dice, okay? No one knows, okay? Even we don't know, okay? So with that said, it's just basically a best guesstimate of where things are based on the information you have at this time. So again, LPL comes out with their research talking about the economy. Basically, outlook for 2024, it's going to isolate a couple blurbs here. Economy, it's going to be from surprisingly strong to a mildly cool. So LPL research expectations, a mild recession in the beginning to mid-year of 2024. The silver lining is interest rates edge down is what they anticipate. Interest rates, they're going to go lower, but they also could stay higher for longer as another aspect too. So just as a idea from LPL. Innovator, again, this is coming from their 2024 investment outlook. Basically, while fears of the recession in 2023 proved premature, again, the market continues to underestimate the likelihood and impact of the Federal Reserve keeping rates higher for longer. Heading into a new year, we think the economy can still grow, but acknowledge that the odds of a recession remain high. So I just wanted to point that out from them, Innovator. Other things, T. Rowe Price, some of their aspects and things that they look at, they were talking about the risk or rates staying higher for longer, inflation, yes, coming down, but still being sticky, and valuations can get elevated again. So those are things that they're looking at as well. Basically, moving on to a few other things here. Deutsche Bank, this was on Fox Business. Okay, Fox Business on December 7th, Fox Business. I just jotted this down. I have to take good notes so you know where I'm citing this from. Okay, so Deutsche Bank person came on and basically they were wrong about the 2022 and 2023 predictions of where the S&P would be. But now they're saying for 2024, the S&P 500 prediction will end the year at 5,100. Okay, so we're basically nearing 4,800. So they're saying 5,100 for Deutsche Bank of what they predict 2024 for the S&P to end at. Okay, that's them. On a call here from, bear with me, Oppenheimer. And this was I have some stats here. I'll just read off to you. So Oppenheimer sees the S&P 500 ending 2024 at 5,200. Okay. So Deutsche Bank was 5,100. Oppenheimer's 5,200. And this was published from investing.com, December 12th from them. NDR, Ned Davis Research, from the webinar I was on 12/7, they also stated the S&P 500 at the end of the year will be 4,900. Okay, so they're more conservative. 4,900 is what NDR stated on the webinar on 12/7 that I was on, Ned Davis Research. Next, HSBC sees the S&P 500 exceeding 5,600 if a recession is avoided. Okay, that's coming from Reuters, basically on 12/13. Again, so I just wanted to point that out. Vanguard's 2024 outlook as of December 14th when this was published. Basically, looking like a slowdown in 2024, Vanguard anticipates the United States and other developed markets will grapple with a mild recession in the coming quarters, and that the central banks will cut interest rates likely in the second half of 2024, amid growth challenges and inflation falling toward the bank's targets. Okay, and one little piece on one more sentence I want to read to you. But what happens on the other side of such of an economic reset? We believe, quote, that the interest rates will remain above the rate of inflation, said Andrew Patterson, Vanguard senior international economist. Quote, the days of ultra-low interest rates are over, and we have greater conviction in this view than we did just a year ago. So again, the easy money is over. All the point I'm trying to get across here on today's episode is no one knows. These are people who are highly paid, highly educated, highly skilled, and track more than even I do. And I'm just pulling things in from different sources, and they're all over the place. Okay, so the theme that we see is going to be more challenging in the first half of the year, okay, versus the back half. So we do anticipate, Q1, quarter one, 2024 will be in a quad 4. Okay, so that's coming from Hedgeye. Okay, I'm on their calls. So just sharing with you what that looks like. So the outlook here over the next few months. So December is a quad 3. Okay, January is a quad 4. February is a quad 4. March is a quad 3. April is a quad 3. So for the next 5 months, you're going to be in quad 3, quad 4 is what they predict. So it's hard to make money. It's about not losing money or losing less, okay? Defensive posture. So that is what's anticipated. Again, I lean on heavily more on Hedgeye on their forecast because they are right more often than they are wrong. And this, so if you're wondering what the Fed's going to be doing next year, they have 8 meetings lined up, okay? First meeting is January 31st. Second meeting, March 20th. So the markets really wanted, they got the cowbell, ding, ding, ding. So yes, the cowbell, it happened. So the Fed, he mentioned, we're going to cut rates 3 times. That was in his notes. Okay, pal, nice job. So he's bending the knee to the markets. So you hear that. But he said that, but he hasn't cut it yet. So the markets are anticipating more than 3 cuts, 5 to 6 cuts. He said 3, okay? And we have talked internally here, we don't think they're going to be cutting rates until at the earliest at the May 1st meeting, May 1st, 2024. That would be at the earliest is our prediction. Could even go to June 12th. Okay, now a lot of these people I've just cited some resources from are saying in the back half of the year. So that means June, July, the back half of the year. So I think the markets are in for a rude awakening. They're not going to get the cowbell, meaning Fed Powell won't be cutting rates as they anticipate sooner rather than later. So there will be an adjustment. And if that occurs in the markets, that flip line is going to turn. You'll see an easy 8, 10, 12% pullback in the stock market, in the S&P. So common, happens all the time throughout the year, but that's what we anticipate, okay? Not to mention all the political risk and geopolitical, worldwide, and everything else. So I just wanted to share with you sort of what's to come, what we anticipate. Nobody knows for sure. But one thing I do want to point out, and then we'll sort of end on this. This is pretty cool. So I've been on a lot of calls People have mentioned this to me. I've been tracking it all year long, but I thought I'd just share this with you. So this is the U.S. debt clock, okay? The usdebtclock.org. So please put this in your bookmark, save it. It just tracks everything. So Nathan will share this with you as well, but let me just go from left to right. I highlighted a few things. So this is the U.S. It's just a running total. These numbers are live. So if you go to that website, you'll see it live. It blows your mind. So the national debt, as I printed this out as of 12/18, so last night's when I printed it out, $33.9 trillion, almost $34 trillion in U.S. national debt, going from left to right, highlighted in yellow. What does that mean? U.S. federal debt as compared to the GDP ratio. That equates to 122% of our GDP, okay? So not good. Give you perspective, 1960, the debt ratio, U.S. federal debt ratio was 52%, 1980, 34%, 2000, 55%, and now it's 122%. So this is unsustainable. So I just wanted to point that out again for folks. So you can't keep on spending another, like they did last week, our House and Senate passed another bill of almost $900 billion. Okay, nice job. I'm kidding. God, ridiculous. But anyways, it is what it is. With that said, moving on. Interest. So the interest on the debt, it's basically $1 trillion now. So for the year, so that's unsustainable as well. Student loan on the bottom there, middle bottom left. Student loan debt is now over 1.7 trillion. 1.7 trillion. Okay. Next to that, you'll see the credit card debt is over almost 1.3 trillion. Okay. 1.3 trillion with over 51% of the people revolving credit, can't pay it off at near average interest rates, almost 23% now. So that's they're getting hammered. Population, I thought was neat, 335 million. Legal U.S. citizens, not to mention the 8 million that's come in over the past few years that are not legal. Medium home prices, now I'm in the center right. Medium home prices now, again, it's new home prices that are being sold. It's just, add it all up. It's $424,000 is the median new home price. Back in 2000, look underneath it, it was $168,000. So average home prices went from $168 back in 2000 to $424. Hello, yeah, unaffordable. Most folks can't afford that, especially at these rates. That's why people are rate locked. Okay, 3%. Plenty of people had it under 3% rates, 30-year fixed. Average a new car now is $51,622. In the year 2000, it was $22,618. Okay, and the average college tuition now was $26,461. In the year 2000, it was $10,906. So I just wanted to point that out. It's pretty cool. Hope you enjoy that. All right, folks. So moving into what everyone's anticipating, the annuity insurance division. Main man, Eric Biddle. All right,
hey,
good
how's
to see
everyone
you.
doing?
Good. Good to have you back in the hot seat.
Yeah, good to be here.
And he couldn't do it, so I had to recruit you. He's like, come on, man, I need somebody.
Second string right here.
No, you're first. It's all good. All righty, well, we've covered a lot, but I just want to talk for all of our clients, give a little bit of history of where we're at. It's been 15-year bull market for the most part. You've had some corrections and things like that in between. But with that said, withdrawal rates. So folks, most clients, as you know, even on your clients, a safe rule of thumb was that 4% rule. Right. So that rule's been around basically since our industry standard since 1994. So since 1994, it's been out there, 4%. And all this is coming from Financial Advisor Magazine, December 2023 issue, some of those facts. So I just wanted to point that out. Okay. But then Morningstar came out here recently, in 2021, saying that the safe withdrawal rate is not 4%, it's 3.3%.
Went down a little bit.
It went down. So, that's had a little people, all fired up. So really what matters, and you've heard, we've talked about this, Andy, and you and I and Russ and others, is a sequence of return risk. So all that means is, so if a person retires and it's a bull market, especially the beginning few years, great. The sequence of return risk is lessened because it's bull market. Let's say you have two bad years.
Yeah.
So your portfolio goes down, you're sucking off 4%.
Right.
It's a double whammy. So hence, you have to have some guardrails, common sense. Thus, why we, Annie, myself, we've been doing fixed index annuities a lot this year and into next year as well. And the reason being is why?
Yeah, I mean, several reasons.
Yeah.
The sequence of return reason, we could put into a financial plan, a client that's about to enter retirement. And if it happens to be when they hit retirement and that we have that big bear market, that's the ugliest time for the bear market. Yeah. So the annuity as part of your overall plan is helpful because it's going to protect from downside risk. Fixed index annuities in particular, your portfolio doesn't go down. So the market can go down 20% 2 years in a row. Your fixed index annuity is still sitting there.
Level, right?
Yeah. So from so they make sense from a portfolio standpoint.
What do you have there?
Yeah. So here's
Where's that from?
Here's actually a little sheet from Nationwide. Okay. Yep. It's one of the carriers that we work with regarding fixed index annuities. So they provide growth opportunity because within the portfolio, they are based on different indices. And as the indices potentially climb, we have the chance to participate in that climb. It also has the principal protection, as I mentioned, where you have the chance for it to go up, but your principal is protected from downside risk. Now, some of these annuities do have fees built in, so there will be a steady, you can see the fee coming out as we show illustrations, but the principal is protected. But the third thing that we really like that some of these annuities provide. Now you have one that you'll talk about that doesn't provide income, but the Nationwide one does provide an income stream. And one of the great things about that is you just talked about the withdrawal rate of 4%. And with the income stream feature, depending on how old you are, when you turn that income stream on, it might pay out at 4% or 5% or 6%, and that's guaranteed for life. So even if the cash runs out in the policy, you're still getting your income stream for life. And some of these offer even a potential for growth in income, even if the cash value is gone.
Evaporates, right?
Yeah. So hopefully we keep up with inflation.
Yeah. No, those are great products. And, we haven't necessarily talked much about annuities, right? I mean, as far as, Andy and I and others,
sure.
Just because really the market's been good, et cetera. But times have changed and things are different and our clientele is getting older. So it really comes down to because of interest rates, right? Insurance companies higher rate.
Yeah.
Book.
Yeah, that makes a huge difference because when you move into a contract now, you're moving into a contract where they can purchase a bond that is a 30-year bond.
30 years.
With a higher rate than we've seen in how many years?
Decades.
Wow, a long time. And so as a result, the features within the annuities actually look really good right now. We're seeing some bonuses that we haven't seen before, and some illustrations look really good. So yes, this for that reason is a great time to consider adding this to part of your portfolio.
And you mentioned the other one, so I've had many clients this year. The Lincoln Financial Group, it's their single premium deferred fixed index annuity. So a month ago, a 5-year guaranteed rate was 6%. Okay. These rates, because the bond market's moved heavily over the past month, as of 12/15, again, here's the rate sheet there, but as of 12/15, it's a fixed rate's 5.5% guaranteed for 5 years. But then there's a performance trigger at 9% and a 1-year cap on the S&P at 10%. But the point is, this has been hot as well, and a mixture of what you want to complement and supplement your portfolio with. So we just offer this. Just want to be sure our clients are aware of our sister company that we have. You're heading it up, and it's been we've been doing a lot of these, Andy, myself, and you. You're the main man. So we appreciate your efforts and helping our clients. And
maybe I could even speak for a moment about how it fits into a portfolio. First of all, we could use either of these kinds of annuities to fit into a portfolio to provide safety. So if you're familiar with Riskalyze, these are a 1 on a scale of 1 to 100 in terms of riskiness. These are a 1. They're safe as cash. And then, so they can fit into a portfolio that way. But when you think about it in terms of income, if you have a client that is receiving Social Security and maybe they're receiving a pension, maybe not. If you can supplement their income with a guaranteed income stream like a fixed index annuity, now you layer that on top and you provide what feels like a paycheck every month. Right. And hopefully that's meeting the basic needs. Yeah. And then after that, the other portfolio money you have is kind of it's icing on the cake. Yeah, exactly.
I love it. Good. All right. Well, I appreciate your insight and expertise and helping everybody, but you've been busy we've been leaning on you a lot this year. So thank you for that. But of course. We just wanted to make you aware, everybody. So keep that in mind too. If you're getting, wanted some, either nervous about the markets or looking for other outside sources to balance out your portfolio, please let us make us aware. And we're just trying to educate you as best we can, and then we're here for you. So we appreciate you. As always.
I appreciate you.
All right, folks. So that's the tips of the month. There's 4 good ones. Some of these are unique. So I ended, if you recall, the us.debtclock.org, but I ended on the college tuition now is $26,461. But I did want to just briefly talk about student aid. We have on our website, under our partners there, we have 2 people that we lean on, College Aid Pro, and then also At the Core. So those are 2. Check out on the site. You'll see them. You can reach out to them as well. But the point is, great information that they do provide. Things I just want to point out to you, what's coming up is the FAFSA. Okay, the FAFSA is the free application for federal student aid. Okay, that's FAFSA, F-A-F-S-A. So typically, that comes out basically in October 1st. But because of the changes, they had question changes. It was 118 questions. Now it's down to roughly approximately 36 questions for most of the users. So just be sure the FAFSA is going to open up here on December 31st. So that's coming right around the corner next week. So for those folks who have college, seniors, etc., be sure that you apply. That window opens December 31st this year. And the reason why I want to read you just a few things here, you want to try to complete it if you can by February 1st. It just puts you in the front of the line for the financial aid office to review your FAFSA submission, provides you with a financial aid award letter sooner, and you can make better decisions, plan effectively, etc. And obviously avoid unnecessary stress for all the members. But in doing so, if you haven't, I do want to hold this up. This is the Federal Student Aid.gov. So again, this is a great website. Nathan, our producer, will have this for you. And then just go to that website. You have to create an account. For you, the parent, you have to create your own account. And for you, the student. So be sure each of you create an account, because you have to do that to put in your own information. So please do that. Click on the little get started, which is key. And then Social Security number, mobile phone, email. That's what you need to create an account. But be sure you both of you do that for those people who are affected by seniors and going into college. And you want to do it every year. File every year. If you don't file for the FAFSA, you can be shut out for some grants and things of that nature. So do it every year. It's easier than ever. So please, and I'm doing it for my daughter. She's a sophomore, but when we do it, we're going to do it every year as well. Okay, moving on. So this is a hedge eye demographer, Neil Howe. This is on 12/6. So this stat came out from him. U.S. life expectancy. This is the combined, okay? This is the combined life expectancy, men, women, all races, what have you. But the point is, the combined, you can see it's gone up. So moved up, elevated, sort of flattened out there for, 10 years or so, 10 years. And then you can see COVID came in 2020, went from 78.8 years down to 76.4. And now it's come back up to 77.5. But quite frankly, it's back in the year, 2002 era. So, sort of sad we haven't, we're back to where we were, life expectancy back then. So just want to share that with you. He's a great person who tracks all the historical information and puts that into a nice, neat little caveat there for you. Moving on to part 3 of tips of the month. This is pretty cool. This isn't unique. You guys know I'm a car guy. So with that said, this is the fastest appreciating cars, okay? So this is all coming from a source I receive, a visual capitalist, okay? It's a visualcapitalist.com. So it was on December 15th on their email that I received. So Visual Capitalist, this is pretty cool. This is the fastest, again, depreciating cars. The number one worst car for holding its value is the Maserati Quattroporte. Okay, so this is car models in 2018 going to 5 years. That's 2023. Okay, so this is as of November 2023, but it's lost 65% of its value over 5 years. So you can just look at the BMW series, what have you. You can look at your favorite car, Cadillac Escalade, down 59%. Infiniti QX80 lost 58% of its value over the 5 years. Audi's A7, Jaguar, etc. So I wanted to share with you that. Thought that was a little interesting. Next one is going to be the slowest, or the cars that hold the value the best. Okay. So again, coming from same institution, the Visual Capitalist, again, as of November 2023, for used car prices from the 2018 models over the 5 year. The car that holds the most value is the Porsche 911. Doesn't go figure, it's a sports car. Only down 9%. It's only lost 9% of its value over 5 years. That's phenomenal. So you can see that Subaru, Honda, Toyota Corolla is only down 25%. That was one of my cars I had when I was a kid in college, actually. I had a yellow Toyota Corolla 2-door with rust in the back seat floor as you drive, and you can see down, see the road. Freaking awesome. Pirelli tires, car phone installed with souped up speaker systems. Great. Hammered that car. It's awesome. Hit a ball. So my buddies remember that. Speaking of buddies, I have a client / friend of mine. I probably have bought 15 or so cars over the past 20 years or so for clients, friends, family members, what have you. I love cars. I understand the negotiation. Doesn't bother me at all. So they bring me in to sort of, get the best deal that my clients can and friends can. So a friend of mine, he just got the word today, actually. He got the green light. It all worked out. He's getting, I call it the beast. It's the AMG car, Mercedes AMG. So it's a credible car. It's just like his last hurrah before he has another more responsibilities coming his way, put it that way. So he's getting it all out, but we had a great time. Test drove it. It was on rails, I will say. That car, I've driven many cars, and that car on rails, through the turns, didn't squeak the tires, couldn't believe it, didn't even lean compared to some other cars that we were driving. So congratulations, good job. Glad he's able to secure that he picks up on this Friday. So a little car thing there. And then last, part 4, this is really unique as well. This is coming from Neil Howe, again, trend spotting from the 12/9 email I received from him. So just to share that with you. So I'm just going to read it if you don't mind. This holiday season, many retailers have adopted a keep it return policy. Instead of giving back the unwanted merchandise that you may have, customers can keep the items free of charge. So this is a new little trend in the industry from the retailers. So Americans are expected to return $173 billion of merchandise this holiday season, the 28% rise year over year. Okay. But increasingly, stores do not want to deal with these returns. So basically, there's basically of the 22 major retail chains that were surveyed, 13 stores have adopted a return policy where shoppers can keep some of the unwanted merchandise. That's more than double the number of stores that had a similar policy in 2022. There were 6 stores that had that. The survey did not disclose the names of the companies because they don't want to have people, make a mad dash for it. But according to Reuters, shoppers have reported the keep it policies are from Amazon, Chewy, Keurig, and Wayfair. So those 4 in particular are the stores that are allowing that keep it. Moreover, they say the average returns cost retailers about $30 for a return. So many stores believe that time and cost of processing these returns aren't worth the effort. I thought that was interesting. So that's a little Christmas tidbit, holiday shopping there for you all. Okay, folks, favorite time, charts. Let's roll through these. This is nothing new to you. Let's talk about the bond market volatility. Here we go. It's the MOVE index. It's a volatility for the bond market right now. It's 118. The average MOVE index is 85. So you're going to see the bonds we have seen move dramatically over the past 6 weeks. The 10-year cradle, 30-year go down as well. Volatility in the VIX, the volatility for the stock market, it's called the VIX. It's 30 days going out. As Elmer Fudd says, it's getting very, very quiet. So the VIX is unseasonably low at 12.6. So we'll see how long it stays down there. But heading into Q1, quad 4, we anticipate the VIX to shoot back up over 20 in no time. Again, the average is 18.5. Currently, it's 12.6. Pullbacks, 5% of the S&P 500. So that happens on average 4.6 times a year. You have a 5% pullback in the S&P. Currently, we've had 3 pullbacks this year. So it's below the average. Corrections / pullback of 10% or more. Again, that happens on average 1.2 times per year. You have a 10% or more pullback in the S&P. So thus far, we've only had 1. Okay. Valuations. Everything's overvaluated by 1 or 2 standard deviations. Excuse me, just a little bit more than 1 standard deviation. So you can see today is a little bluish diamond chart. And a year ago, we see the red X. You can see where we were, the market's valuation, PE, price to book, price of sales, price of cash flow, and dividend. And the X versus where we are today. So things are elevated. U.S. economic growth. So with that, GDP, quarterly GDP, great surprise we had for the Q3 of 2023 was 5.2%. Fourth quarter 2023 is going to be north of 2% is what's anticipated. Let me share with you what Hedgeye has predicted, and this is coming from them. So you're going to have first quarter and second quarter flat to sub-zero negative GDP growth rate, first 2 quarters, okay? So that is what's coming. So you're going to have a major reversal, hence why we have all these different institutions talking about first half will be more challenging. So that's what we anticipate. S&P 500 earnings growth rate, we talked about that, how things have at least turned the corner. The average historical is 7.7. The latest is negative 0.4 tenths, but almost flat. So things are turning around. Interest rates, the 10-year, 2-year, we talked about that. Check that out on this graph, the gold line and the blue line. It got real close to becoming uninverted. So inversion means the 2 years providing more yield than the 10-year. And then you can see just a couple of weeks ago, the 2-year and 10-year got really, really close to each other to becoming uninverted. That means the 10-year is going to get higher yield than the 2-year, but it didn't. Now we flip back. So it's been inverted for a year and a half now plus, and you'll see that on the next page. The yield curve, the 10s minus 2s, the spread's about 48 basis points, so almost a half of a percentage spread. So it got close to uninverting, and now it's reinverted. And when you have that going on, typically it leads to a recession. Unemployment. The U6 is the underemployment. You can see that's gone back up to 7%. But really, the government, the Fed, follows the U3. The average employment's 5.9. Right now, it's 3.7. It was 3.9. Last month, it kicked back lower, down to 3.7. But the Fed, trying to navigate and thread the needle for a soft landing, they want that to see. They don't anticipate it going north of 4.1 in 2024. We'll see if it doesn't go any higher than that. But they want wage growth to go down, unemployment to go up, et cetera. And then, hopefully they can try to thread that needle for a soft landing. Leading economic indicators, as you can see, currently it's negative 7.6. So these are major confidence LEI leading economic indicators. And when you're negative, recessions are shaded. So again, it doesn't look good. And this is why we've been calling for that rolling recession. Parts are in it, parts are not. CPI, consumer price, X food and energy. You can see the core, it's X food and energy is 4%. Okay, it's definitely come down. That's great, but still elevated. What matters more is the PCE. Next one, PCE is personal consumption expenditure. So with this PCE, the federal target rate's 2% on the PCE, and the core for that is at 3.5. So again, they want the 3.5 core PCE to get down to 2. You're 1.5% away from that, so still more work to do. So higher for longer is what Fed Powell will be doing. So you've been saying that for a long time, but Q1, it's all we'll see. He's going to be under enormous pressure by people, everyone, to start cutting rates. We'll see if he can hang in there or not. Oil and the U.S. dollar. You can see it's an inverse reaction there. Oil is on the left side. So oil has come off the near $100 dollar price. Now it's 72.16. So it's come down. And then the dollar has weakened. Okay, the dollar was 106, 108. It's 106, excuse me. It's come back down to right now 102, spot 56. So as a weakening dollar, that's good for international companies and emerging markets, things of that nature. Savings rate, you can see savings rate, the average historical is 6.3%, and right now it's 3.8. So again, people, it's tough out there. They're burning through, living on savings and a credit card. And here on the Social Security COLA, as a reminder, 3.2% is your COLA cost of living adjustment in January. For those on Social Security, that's great. Trying to keep up with cost of living, which we know is much higher than that. But anyways, last year was well over 8%, and the year before that, in 2021, again over near 6%. And then thank you, Merry Christmas, Happy Hanukkah, and to all of you for a great 2023. It's been crazy. 2024 should be even crazier, but hang in there. Reach out to us for any questions that you may have. On behalf of Andy, Stacy, myself, Jim, Russ, Eric. Be safe, enjoy your loved ones, family, keep the faith, and we'll see you soon. Thank you.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners, TNWP, are separate entities. The opinions voiced in this show are for general information only. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. This content does not constitute the rendering of personalized investment advice. A professional advisor should be consulted before implementing any of the options presented.